So imagine buying a stock, right? But instead of a company with factories or software, its main asset is just a massive pile of Bitcoin. Today, we're going to dive into that fascinating corner of the market, digital asset treasury companies, or DATs for short. These are publicly traded companies whose entire business model is basically built on a balance sheet that's just packed with crypto.
Yeah, this quote absolutely nails it. See, they're not just some passive fund, they're active vaults with a CEO. That means you've got a management team, you've got a list of owners, and they're making active decisions. And here's the wild part. They create this powerful feedback loop. When the stock price goes up, they can issue more shares to buy, you guessed it, more crypto. And that can push the stock price up even further. That's the reflexivity, that crazy cycle.
Okay, so this slide really breaks down the key difference. On one side, you've got your standard ETFs. Think of them as passive vaults. They just buy an asset and hold it. Super simple direct exposure. But on the other side, you've got DATs, the active vaults. These guys don't just hold crypto, they are actively raising money through stocks and debt for one single purpose, to acquire more crypto. This creates a really powerful leveraged bet on the market. All right, here's our roadmap for this. First, we'll unpack what crypto in a stock wrapper really means. Then, we'll tackle the big question. Why not just buy crypto directly? After that, we'll get into the risks, the double-edged sword. And finally, we'll look at some real-world examples of these companies.
Okay, let's start with the basics. Section 1, crypto in a stock wrapper. So what exactly is a DAT?
The definition is actually super straightforward. A DAT is just a publicly traded company that makes holding cryptocurrency its core business strategy. This isn't some side hustle or a tiny part of their portfolio. For them, holding digital assets is the entire business. And you can usually spot them by these three key traits. First, they have a huge crypto treasury, and they tell everyone about it. It's public. Second, they are always raising capital, issuing new stock, taking on debt, all for the express purpose of buying more crypto. And third, the company's stock price is almost entirely tied to the value of that crypto treasury. You're essentially buying a piece of their crypto wallet, just listed on the stock exchange. Which, brings us to the most important question of all. Section 2. Why not just buy the crypto yourself? Let's get into the case for why these things even exist.
So yeah, this is the crucial point, right? If you want to own Bitcoin, why would you go through a company like this instead of just opening an account on a crypto exchange and, well, buying Bitcoin? Turns out there are some very, very rational reasons.
The first one, and honestly, maybe the biggest, is all about the boring stuff. Rules, regulations, and compliance. A lot of large institutions, think pension funds, big endowments, they have really strict rules that just flat out prevent them from holding crypto tokens directly.
And this quote just sums it up perfectly. Imagine you're a fund manager. Getting your committee to approve holding actual Bitcoin can be a total administrative nightmare. But buying shares in a publicly listed, fully audited company, hey, that fits right into their existing process. It's basically a compliance workaround that uses the familiar plumbing of the stock market.
And that leads right to operational simplicity. You see, holding crypto yourself means dealing with wallets, private keys, smart contract risk. It can be a real headache. Buying a DAT share? That's as easy as typing a ticker into your brokerage account. Done. You get normal corporate governance, audited financials, and for a lot of people, that alone is worth the price of admission. So you've got compliance, you've got simplicity. But the real reason a ton of investors are drawn to these is where things get a little spicy. Embedded leverage. These companies can sell stock for more than their crypto is actually worth, or they can take on debt. And what this lets them do is hold way more crypto per dollar of capital than you ever could on your own. So in a bull market, this thing acts like a levered call option. It just turbocharges returns. And finally, there's this extra little kicker called equity optionality. This is the idea that you're not just buying a pile of crypto. See, some of these DATs also have real operating businesses, like a crypto exchange or a mining operation. So you get the exposure to their crypto treasury, plus the potential upside if their actual business explodes. It's kind of like getting a free lottery ticket on their success. Okay, but all that leverage and complexity, well, it's a massive double-edged sword. And that brings us to Section 3, the hidden risks hiding inside these companies. Because for every single upside, there's a serious downside. That same leverage that juices your returns on the way up, it absolutely hammers you on the way down. That premium the stock trades at can expand, sure, but it can also just collapse. Which means, and get this, you could lose money on the stock even if the price of the actual cryptocurrency doesn't move an inch.
So the bottom line is this. When you buy a day yet, you are not just betting on the price of a token. You're also taking on risk from the company's debt, you're taking on risk from the decisions of the management team, and you're taking on risk from the market's mood about the stock itself. It is a much, much more complex bet.
Okay, enough of the theory. Let's make this way more concrete by looking at some real companies. Section 4, dates in the wild.
Here are a few of the key players you might see. Of course, there's the famous one, MicroStrategy. They're kind of the original gangster here, the first big DAT, a pure leveraged bet on Bitcoin. Following their playbook, you've got Metaplanet, which is basically doing the same thing for the Japanese market. Then you get specialists like Bitmine Immersion, which focuses on Ethereum and even stakes its coins for extra yield. And finally, you have these hybrids like Galaxy Digital, which has a huge crypto treasury and an active investment bank, which gives you that equity optionality we talked about. So how do the pros actually use these in a portfolio? Well, they might use a big one like MicroStrategy as a simple levered proxy for Bitcoin, or they could use smaller, more speculative DATs for really short-term tactical trades. And some even play this complex relative value game, basically trading the gap between the stock's price and the actual value of its crypto.
So at the end of the day, when you see these tickers flying across your screen, what should you take away? Just think of them as structured crypto products that are dressed up in stock market clothing. They can be incredibly useful tools if you really understand all the moving parts, the leverage, the management, the premiums. But if you don't, they can be incredibly dangerous. It really all comes down to knowing what you're actually buying.